The greatest investors don't chase miracles. They recognize them in parking lots. Peter Lynch spent 13 years running the Fidelity Magellan Fund, and in that time, he turned $20 million into $14 billion. His annual returns averaged 29%. But here's what matters more than the numbers. He found his best ideas at shopping malls, in grocery stores, watching his wife buy pantyhose. He believed the amateur investor had advantages the professionals didn't. He believed you could spot a 10-bagger, a stock that returns 10 times your investment, by simply paying attention to the world around you. And now you're 50 or 60 or older, and you're wondering if any of that still applies to you. The answer isn't simple, but it's honest. And honesty, at this stage of life, matters more than hype. This is not investment advice. This is not a recommendation to buy or sell any security. This is a conversation about philosophy, about patience, about what's possible when you combine experience with realism. Always consult with a qualified financial advisor before making any investment decisions. What follows it is exploration, not instruction. So let's explore the question directly. Can you find 10 baggers after 50? Can you take a portion of your savings, invest it wisely, and watch it grow tenfold before you need it? And more importantly, should you even try? Peter Lynch would tell you something unexpected. He'd say the question itself reveals a misunderstanding, because Lynch never went looking for 10 baggers. He went looking for good companies. Some of them happened to return 10 times his money. Some returned 50 times. Some returned nothing. The 10 baggers emerged from a disciplined process, not from a desperate search. And that distinction changes everything when you're over 50. Because by the time you reach this age, you understand something the young investor doesn't. You understand that time is finite. You understand that recovering from mistakes takes longer than it used to. You understand that your retirement isn't some distant abstraction. It's a date on a calendar, approaching faster than seems fair. The margin for error is gone. That reality should change how you invest. It should make you more careful, more selective, more focused on preservation than on home runs. And yet, and this is where Lynch's wisdom becomes relevant, it shouldn't make you timid. It shouldn't make you abandon the search for quality growth entirely. Lynch believed in something he called investing in what you know. He meant it literally. He found Dunkin Donuts because he loved their coffee. He found Toys R Us because his children dragged him there every weekend. He found the Gap because he noticed how busy their stores were. He wasn't using complex algorithms or insider information. He was using his eyes. Now imagine you're 62. You've been working for 40 years. You've watched industries rise and fall. You've seen products come and go. You've witnessed which businesses treat their customers well and which don't. You've accumulated 4 decades of pattern recognition that no 25-year-old analyst can match. That's your edge. That's your version of Lynch's shopping mall strategy. The question isn't whether you can find 10 baggers after 50. The question is whether you can afford to look for them and whether you have the patience to hold them if you do. Let's start with Lynch's philosophy, because understanding how he thought will help us understand what's still applicable at your stage of life. Peter Lynch didn't invent stock picking, but he perfected the art of making it accessible. Before Lynch, investing seemed like a dark art practiced by men in expensive suits who spoke in code. Lynch demystified it. He spoke in plain language. He used analogies anyone could understand. He made investing feel less like mathematics and more like common sense. His most famous principle was simple: invest in what you know. But people misunderstand what that means. It doesn't mean buy stock in your favorite restaurant because you like their burgers. It means use your knowledge of that restaurant, how busy it is, how efficient the service, how the quality compares to competitors, as the beginning of your research, not the end of it. Lynch would notice a busy store. Then he'd look at the financials. Then he'd study the management. Then he'd assess the growth potential. Then, if everything aligned, he'd buy. The observation was the spark. The analysis was the fire. And here's what mattered most to Lynch. He didn't need every investment to be a home run. He knew most of his stocks would be singles or doubles. A few would strike out entirely. But if he could find a handful of companies that grew explosively, they would more than compensate for the mediocre performers. He called this approach cutting your weeds and watering your flowers. When a stock underperformed and the reasons for buying it no longer held true, he sold. When a stock performed well and the company's fundamentals remained strong, he held, often for years. That patience created the 10-baggers. Not luck, not genius, patience. But patience operates differently when you're over 50. When Lynch was running Magellan, he was in his 30s and 40s. He could afford to hold a stock for a decade. He could afford to wait through temporary setbacks. Time was on his side. Time is no longer unconditionally on your side. But that doesn't mean Lynch's principles are useless to you. It means they need adaptation. Here's the truth. You probably shouldn't be swinging for 10-baggers with your entire portfolio, but you might consider swinging for them with a small, carefully defined portion. Let's get practical. If you have $300,000 saved for retirement, putting all of it into speculative growth stocks would be foolish. But putting 15,000, 5% into 2 or 3 carefully researched companies with explosive potential, that's not reckless. That's strategic. The worst case, you lose the 15,000. Painful, but not catastrophic. The best case, one of those companies returns 10 times your investment over the next decade, turning 15,000 into 150,000. That's not retirement defining money, but it's vacation redefining. It's legacy enhancing. It's the difference between comfortable and genuinely secure. And here's what Lynch understood that many people forget. Finding a 10-bagger doesn't require perfect timing. You don't need to buy at the absolute bottom and sell at the absolute top. You just need to identify a great company early in its growth story and have the discipline to hold through the volatility. Lynch used to say that the stock market's real money is made not in buying and selling, but in waiting. He'd point out that if you bought 10 stocks and 9 of them went to zero, but the 10th became a 10-bagger, you'd break even. If the 10th became a 20-bagger, you'd double your money despite being wrong 90% of the time. That math doesn't change after 50. What changes is how much of your portfolio you can responsibly dedicate to that strategy. So let's talk about what Lynch looked for in a potential 10-bagger and how someone over 50 might apply those criteria today. Lynch categorized stocks into 6 types: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. The 10-baggers almost always came from the fast growers, companies expanding rapidly in industries with long runways ahead of them. But Lynch had specific criteria. He wanted companies with strong earnings growth, at least 20 to 25% annually. He wanted companies in industries that weren't overcrowded with competitors. He wanted companies with a sustainable competitive advantage, what Warren Buffett would later call a moat. He wanted management teams that owned significant shares in their own companies, aligning their interests with shareholders. And crucially, he wanted companies that were still relatively small. A company with a market value of $1 billion can grow to $10 billion far more easily than a company worth $100 billion can grow to $1 trillion. All of this remains true today. The principles haven't changed, but the landscape has. When Lynch was investing in the 1980s and early 90s, technology was emerging but not dominant. He found 10 baggers in retail, restaurants, healthcare, and regional banks. Today's economy looks different. Technology pervades everything. The fastest-growing companies often operate in digital spaces that didn't exist during Lynch's tenure. Does that mean someone over 50 can't understand them? Absolutely not. Think about what you do understand. Maybe you've watched your children or grandchildren become absorbed in certain apps or platforms. Maybe you've noticed which software programs your employer adopted and how transformative they were. Maybe you've seen certain medical devices or treatments change someone's life. Maybe you've observed the explosive growth of electric vehicles or solar panels in your neighborhood. These observations matter. They're your version of Lynch noticing a busy Dunkin Donuts. But here's where age becomes an advantage. You've seen hype cycles before. You remember the dot-com bubble. You remember when everyone thought certain companies would change the world and most of them didn't. You've developed skepticism that protects you from the worst mistakes. A 30-year-old investor might pour money into the latest trending stock because everyone on social media says it's the future. You're less likely to fall for that. You ask harder questions. You want to see proof, not promises. That skepticism, combined with genuine curiosity about new industries, is a powerful combination. Lynch would tell you to start with what's changed in your life over the past decade. What products or services do you use now that you didn't use 10 years ago? What companies provide those products? Are they public? Are they growing? Are they profitable? And then, this is critical, he'd tell you to do the homework. Read the annual reports. Understand the business model, study the competition, look at the debt levels, examine the management team. Don't buy a stock just because you like the product. Buy it because you've done the work and concluded it's undervalued relative to its growth potential. That process takes time. It takes effort. And at this stage of life, you might wonder if it's worth it. Here's the answer. It depends on what you're looking for. If you're looking for guaranteed safety, then no. Individual stock picking isn't for you. Keep your money in diversified index funds and sleep well at night. Nothing wrong with that approach. It's sensible. It's probably what most of your money should be doing. But if you're looking for engagement, for the intellectual stimulation of researching companies, for the satisfaction of making your own decisions, for the possibility of finding something genuinely special, then yes, dedicating a small portion of your portfolio to Lynch-style investing might enrich your life in ways that transcend the financial returns. Because here's something else Lynch understood. Investing can be enjoyable. It can be a hobby that pays you instead of costing you. It can keep your mind sharp. It can give you something to study and discuss and get excited about. Just don't confuse enjoyment with carelessness. Lynch was rigorous. He read everything. He visited companies. He talked to competitors and suppliers. His success came from work, not from hunches. If you're going to look for 10 baggers after 50, you need to commit to the research. Half-hearted stock picking is worse than no stock picking at all. Now let's address the psychological challenge, because this is where age matters most. When you're 30 and you buy a stock, you can afford to wait 15 years for it to pay off. When you're 60, 15 years takes you to 75. That's a different calculation. You start asking yourself, will I even be around to enjoy the gains? Will my health hold up? Will I need this money sooner than I think? These are reasonable concerns. They're why most financial advisors recommend a conservative allocation as you age. Stocks become a smaller percentage of your portfolio. Bonds and cash become larger. But Lynch would remind you of something important. Retirement isn't a finish line where you immediately need all your money. If you retire at 65 and live to 90, that's 25 years. A stock you buy at 65 could become a 10-bagger by 75 and still give you 15 years to enjoy the wealth or pass it to your children. The question isn't whether you have enough time. The question is whether you can emotionally handle the journey, because 10 baggers don't move in straight lines. Lynch's greatest winners often fell by 30, 40, even 50% before eventually soaring. If you bought a stock at $20 and it fell to 10, would you panic and sell? Or would you review your original research, confirm the business fundamentals remained strong, and hold, or even buy more? Your answer to that question determines whether you're suited for this strategy at any age, but especially after 50. Lynch talked about something he called the stomach test. He said the real key to making money in stocks isn't your brain, it's your stomach. Can you handle the volatility without losing sleep? Can you watch a position drop 20% and not panic? Can you ignore the market noise and trust your research? If you can't, then you shouldn't be picking individual stocks regardless of age. Put your money in an index fund and enjoy your retirement without the stress. But if you can, if you have the emotional discipline to separate short-term price movements from long-term business fundamentals, then age might actually work in your favor. Because you've seen market crashes before. You've lived through 2008, through the dot-com bust, through Black Monday in 1987 if you're old enough. You know, viscerally, that markets recover. Young investors know this intellectually. You know it in your bones. That experiential wisdom is invaluable. Still, there's a practical consideration that can't be ignored. When you're accumulating wealth in your 30s and 40s, you have income flowing in regularly. If the market crashes, you can buy more shares at cheaper prices. You can dollar-cost average your way through the turbulence. When you're retired or nearing retirement, you might not have that luxury. You might be drawing down your portfolio, not adding to it. A major market decline at the wrong moment can damage your financial security permanently. Sequence of returns risk is real. This is why the 5% rule makes sense. If you dedicate 5 to 10% of your portfolio to hunting for 10 baggers and the rest is in stable, diversified investments, a crash in your growth stocks won't devastate you. It will sting, but it won't derail your retirement. And if one of those growth stocks succeeds, if it becomes the next Home Depot or Walmart or Microsoft, companies Lynch identified early and rode to enormous gains, the payoff could be transformative. Let's talk about what Lynch got wrong, because understanding his mistakes is as important as understanding his successes. Lynch missed plenty of opportunities. He occasionally held on to losing positions too long, hoping they'd recover when he should have admitted defeat. He sometimes bought companies that looked cheap, but were cheap for good reasons. He experienced the same frustrations every investor faces. The great company you researched thoroughly but never pulled the trigger on, only to watch it soar without you. But Lynch's mistakes were never reckless. He never bet the farm on unproven concepts. He never chased momentum without understanding the underlying business. He never let ego override evidence. And that's the model for someone over 50. You're not trying to hit every pitch. You're not trying to outsmart the market daily. You're trying to identify 2 or 3 genuinely excellent businesses, buy them at reasonable prices, and let time do the work. Lynch used to say that everyone has the brain power to follow the stock market, but not everyone has the stomach. After 50, you might add another requirement. Not everyone has the patience. Because here's the paradox. The closer you get to needing your money, the more patient you need to be when you're investing a portion of it for growth. If you're 62 and you've decided to dedicate 5% of your portfolio to looking for 10-baggers, you can't check the prices every day. You can't panic when your holdings drop 15%. You can't sell every time some analyst issues a negative report. You have to do the work up front, the research, the due diligence, the careful analysis, and then you have to trust it. You have to give your thesis time to play out. Lynch held Walmart for years while other investors called it overvalued. He held it because the business kept growing, kept opening new stores, kept gaining market share. The stock price was irrelevant as long as the business fundamentals remained strong. That kind of patience is harder to maintain when you're older because the stakes feel higher. Every year that passes is a year you can't get back. Every dollar you lose is a dollar that might have funded something meaningful. But the flip side is equally true. Every dollar that grows tenfold is $10 that can fund something extraordinary. The key is calibration. You're not risking money you need for health care or housing. You're risking money that, if you lost it entirely, would be deeply disappointing, but not life-ruining. And you're giving yourself the chance, not the guarantee, but the chance to find something special. Let's consider what a Lynch-style portfolio might look like for someone in their 50s or 60s today. You'd start with your core holdings, probably 60 to 70% in a diversified mix of index funds, bonds, and stable dividend-paying stocks. This is your foundation. This is what pays your bills and lets you sleep at night. Then you'd have 20 to 30% in individual stocks you've researched and believe in. Quality companies with strong track records, reasonable valuations, and sustainable competitive advantages. These aren't moonshots. These are solid businesses you expect to grow 10 to 15% annually over the next decade. Companies like the ones Lynch called stalwarts. And then you'd have 5 to 10%, no more, in your growth basket. These are the potential 10-baggers. Smaller companies, higher growth rates, more volatility, more risk, but also more upside if you're right. Within that growth basket, you'd own maybe 2 to 5 individual stocks, not 20, not 50. 2 to 5 companies you've studied exhaustively and genuinely believe have the potential to multiply several times over the next decade. And here's the critical part. You'd decide in advance what would make you sell. Not a price drop. Price drops or noise. But what fundamental change in the business would invalidate your thesis? Is it a certain level of debt? A management change? A new competitor? A shift in consumer behavior? Lynch was ruthless about this. When the reasons he bought a stock no longer applied, he sold, even if the stock was still rising. And when the reasons remained valid, he held, even if the stock was falling. That discipline matters more than anything else, because without it, you'll sell your winners too early out of fear of losing your gains, and you'll hold your losers too long out of hope they'll recover. Lynch called this pulling out the flowers and watering the weeds. It's the most common mistake investors make. After 50, you can't afford that mistake. Your time horizon demands better decisions. So what kinds of companies might qualify as potential 10-baggers today, viewed through Lynch's lens? Lynch would tell you to look for companies benefiting from long-term trends that are still early in their development. In his era, that might have been the shift to suburban retail or the expansion of casual dining. Today, it might be the aging of the population itself. Think about it. You understand aging in a way younger investors don't. You know what it feels like to need reading glasses, to worry about joint pain, to think about health care differently. You know which products and services become essential as people age. Are there companies providing solutions to aging populations that are still relatively small but growing rapidly? Medical device companies? Home health care services? Pharmaceutical companies working on age-related conditions? Senior living operators that treat residents with dignity? These are industries you can understand viscerally, and understanding is the first step. Or consider environmental and infrastructure changes. You've watched your neighborhood change over decades. Maybe you've noticed the shift to electric vehicles, or the installation of solar panels, or the upgrade of water systems. Are there companies leading these transitions that are still small enough to multiply several times? Or think about the businesses your children and grandchildren use obsessively. What platforms do they spend hours on? What services have become indispensable to them? Lynch found Toys R Us by watching his kids. You might find the next great growth stock by watching yours. But, and this is essential, you can't just buy the stock because it's popular with young people. You have to understand why it's popular, whether that popularity is sustainable, and whether the company can monetize it profitably. That's where homework comes in. That's where you read the annual report, study the competitive landscape, and assess whether the company has pricing power and a defensible market position. Lynch spent hours every week reading. He'd go through hundreds of annual reports. He'd visit companies. He'd talk to people in the industry. He didn't rely on tips or hunches. He relied on information. If you're going to hunt for 10 baggers after 50, you need to commit to the same level of rigor. Otherwise, you're not investing. You're gambling. And gambling with your retirement savings is a sin. There's another aspect of Lynch's philosophy that becomes more relevant with age: the importance of simplicity. Lynch loved simple businesses. He was suspicious of companies with complicated business models or opaque accounting. He wanted to understand in plain language how a company made money. If he couldn't explain it to a 12-year-old, he didn't invest. That's wisdom you can embrace at any age, but especially now. The older you get, the less tolerance you should have for complexity. Complexity hides risk. Simplicity reveals truth. So when you're evaluating a potential investment, ask yourself, Can I explain this business model to my spouse in 2 minutes? Can I describe the company's competitive advantage in one sentence? Do I understand where the revenue comes from and why customers keep coming back? If the answers are no, move on. There are plenty of simple, understandable businesses that grow rapidly. You don't need to invest in things you don't understand, no matter how exciting they seem. Lynch proved this. Some of his greatest winners were extraordinarily simple: a donut shop, a toy store, a discount retailer. The businesses weren't complex. The insight was recognizing their growth potential before everyone else did. You can do the same. You just need to pay attention and be willing to do the work. Now, let's talk about something Lynch emphasized, but investors often ignore: the importance of selling. Lynch was a buyer and a seller. He didn't fall in love with his stocks. He didn't let ego prevent him from admitting mistakes. When a company's story changed, he changed his position. This is hard for everyone, but it might be especially hard when you're older. You put in all that research, you made the decision, you watched the stock for years. Selling feels like admitting defeat. But Lynch would tell you that selling is how you generate returns. It's how you reallocate capital from underperforming investments to better opportunities. It's how you prevent small mistakes from becoming large ones. And if you're fortunate enough to find a 10-bagger, if one of your carefully researched stocks multiplies 10 times, Lynch would tell you to think carefully about selling part of your position to lock in gains. He called this taking some off the table. If a stock had grown to represent 20% of your portfolio when it started at 2%, you'd sell enough to bring it back to a more reasonable allocation. You'd still own the stock, still benefit if it kept rising, but you'd have reduced your risk and captured some profit. After 50, this discipline matters even more. You don't have decades to recover if your big winner suddenly becomes a big loser. Taking some profit along the way isn't cowardice, it's prudence. But selling winners too early is also a mistake. Lynch held some stocks that became 10-baggers and then kept holding, watching them become 20-baggers or more. The key was that the business fundamentals kept improving. The growth story remained intact. As long as that was true, selling made no sense. This is where judgment comes in. And judgment, more than analysis, is what you've developed over decades of life experience. You've learned to distinguish between temporary setbacks and permanent deterioration. You've learned to recognize when something is truly broken versus when it's just going through a rough patch. That judgment is your edge. Use it. Let's address the elephant in the room. What if you're wrong? What if you spend months researching a company, invest $5,000, and it goes to zero? What if your thesis was flawed, or the industry changed, or you just got unlucky? Lynch would tell you this happens. It happened to him. He had stocks that went to zero. Every investor does if they're taking any risk at all. The question isn't whether you'll be wrong sometimes. The question is whether your winners will be big enough to offset your losers. And that's where position sizing and diversification within your growth basket become critical. If you put all $10,000 into one speculative stock and it fails, you've lost $10,000. If you put $2,000 into 5 different stocks and one fails, you've lost $2,000 but still have $8,000 invested in the others. If one of those others becomes a 10-bagger, you're significantly ahead. Lynch used to say that if you have 100 stocks in your portfolio, which he did at Magellan, you only need a few big winners to have a great year. The mediocre performers don't hurt you. The losers don't destroy you. The winners make you. You're not going to own 100 stocks in your growth basket, but the principle applies. Spread your risk across a few carefully selected companies rather than betting everything on one. And if you lose money on a position, don't let it embitter you or make you abandon the strategy entirely. Analyze what went wrong. Learn from it. Apply that learning to your next decision. Lynch lost money on plenty of stocks. He never let those losses define him. He focused on getting more decisions right than wrong and making sure his right decisions were bigger than his wrong ones. That's all you need to do. It's simple. Not easy, but simple. There's one more aspect of Lynch's philosophy we need to discuss: the psychological benefit of ownership. Lynch believed that owning stocks in companies you understood and believed in made you a better, more engaged investor. You paid attention to the news differently. You noticed when competitors opened or closed. You tracked industry trends. You became an informed observer of the businesses you owned. That engagement has value beyond the financial returns. It keeps your mind active. It gives you something to think about and discuss. It makes you feel like a participant in the economy rather than a passive bystander. After 50, that engagement can be deeply satisfying. Retirement isn't just about having enough money. It's about having purpose, curiosity, and intellectual stimulation. If researching companies and following your investments provides that, then the activity has value even if the returns are modest. Just don't confuse the pleasure of the activity with permission to be careless. Lynch enjoyed investing, but he never stopped working hard at it. So here's the honest assessment. Can you find 10 baggers after 50? Yes, it's possible. The principles Lynch used are timeless. Great companies still grow rapidly. Observant investors still have advantages. Patience still gets rewarded. But should you make this the core of your retirement strategy? No, absolutely not. Your core strategy should be stability, diversification, and preservation. The growth basket, the hunt for 10 baggers, should be a carefully bounded experiment, a calculated risk taken with money you can afford to lose. And you need to be honest with yourself about whether you have the temperament for it. Not everyone does. There's no shame in acknowledging that you'd rather have peace of mind than the possibility of outsized returns. But if you do have the temperament, if you're curious, disciplined, patient, and willing to do the homework, then dedicating a small portion of your portfolio to Lynch-style investing might be one of the most rewarding things you do in your later years. Not because of the money, though the money would be nice, but because of the engagement, the learning, the satisfaction of making your own decisions and living with the consequences. Lynch retired from Magellan at age 46. He'd made enough money and decided he wanted to spend more time with his family. He could have kept going, kept chasing returns, kept proving himself. But he chose differently. That choice says something important. At a certain point, life matters more than wealth. Relationships matter more than returns. Peace matters more than performance. But Lynch never stopped being curious about businesses. He never stopped noticing which companies were thriving and which were struggling. He never stopped thinking like an investor, even after he stopped managing money professionally. That's the sweet spot, staying intellectually engaged without letting it consume you. Investing a portion of your savings in carefully selected growth stocks without letting it become an obsession. Hunting for 10 baggers while remembering that life itself is the ultimate investment. Because here's the truth Lynch understood and demonstrated. Investing isn't an end in itself. It's a means to freedom, security, and the ability to live life on your own terms. If you're over 50, you've already done the hard part. You've worked for decades. You've saved. You've built a foundation. Now the question is how to make the next chapter as rich and meaningful as possible. Maybe that includes finding a 10-bagger or two. Maybe it doesn't. Either way, you'll be fine if you've been prudent, if you've avoided catastrophic mistakes, if you've lived within your means. But if you choose to dedicate a small portion of your wealth to the search, if you decide to study businesses, make careful decisions, and give yourself a chance at something extraordinary, you might discover that the real reward isn't the money. It's the engagement, the learning, the satisfaction of knowing you stayed in the game, stayed curious, stayed alive to possibility, even as the world tried to convince you that your best years were behind you. Lynch never believed in looking backward. He believed in looking forward, always searching for the next great opportunity. Age wasn't a disqualification. Experience was an advantage. You have that experience now. The question is what you'll do with it. Will you play it safe with everything? That's fine. That's reasonable. That's what most people should probably do. Or will you take a small portion, 5%, maybe 10%, and give yourself permission to hunt, to research, to decide, to own, to participate in the growth of companies you believe in? If you choose the latter, do it with Lynch's discipline. Do the homework, understand the business, know your sell criteria, diversify your bets. Keep your position sizes reasonable. Don't let emotion override analysis. And remember, you're not trying to get rich quick. You're trying to steadily build wealth over the next 10 to 15 years while enjoying the process. That's possible. Lynch proved it, and the principles he used haven't changed. But it requires honesty about your goals, your temperament, and your limitations. It requires accepting that you'll be wrong sometimes and right sometimes, and that's okay as long as your rights are bigger than your wrongs. Most of all, it requires perspective. The stock market will survive without you. The economy will continue whether you're invested or not. But your time, your peace, your relationships, those are irreplaceable. So invest in what matters most. And if you decide that includes investing in a few carefully chosen companies with explosive potential, then do it with Lynch's wisdom guiding you. Stay patient, stay informed, and never invest in anything you don't understand. The 10 baggers, if they come, will come from that discipline, not from luck, not from hope, from doing the work and letting compound growth do what it does best. And if they don't come, if your carefully chosen stocks return 2 times your money instead of 10, or if they break even, or even if some lose money, you'll still have done something valuable. You'll have stayed engaged. You'll have kept learning. You'll have refused to let age be an excuse for passivity. That's worth something, maybe everything. Peter Lynch loved investing because it was a puzzle that never got boring. Every company was a new story. Every industry had its own dynamics. Every market cycle taught new lessons. You can have that same curiosity now. You can look at the world around you and ask, what's working? What's growing? What do people need? What businesses are solving real problems in sustainable ways? And then you can decide, is this something I want to own? Is this a story I want to participate in? Is this worth a piece of my hard-earned savings? If the answer is yes, then buy, hold, be patient. Let the business do its work. And if the answer is no, then don't. There's no rule that says you must hunt for 10 baggers. There's no requirement to take unnecessary risks. You've already won the game by getting this far, by saving enough, by avoiding catastrophic mistakes. Anything beyond that is a bonus, a choice, an opportunity, not an obligation. Lynch would remind you of one final truth. The stock market is a device for transferring money from the impatient to the patient. After 50, you should be the most patient investor in the room. You've learned that lesson in every other area of your life. Now apply it here. Don't chase. Don't panic. Don't trade frantically. Just own good businesses and let time do the heavy lifting. If you can do that, if you can combine Lynch's principles with your own accumulated wisdom, then yes, you can find 10 baggers after 50. But more importantly, you can find something else. The satisfaction of knowing you never stopped growing, never stopped learning, never stopped believing that tomorrow holds possibility. That's the real return. That's what makes the journey worthwhile. And in the end, that's what Peter Lynch understood better than almost anyone. Investing isn't about the money. It's about the life the money makes possible. It's about freedom, security, generosity, and peace. You've worked 40 years for those things. Now make sure your money works just as hard for you. Not recklessly, not desperately, but thoughtfully, patiently, with the wisdom that only comes from experience. Do that, and the 10 baggers will take care of themselves. Or they won't. Either way, you'll be fine. Because you've already learned the most important lesson. Surviving beats brilliance every single time, and you've survived. Now, decide what you want to do with all that hard-won knowledge. The market is open. The opportunities are there. And you've got more wisdom than you give yourself credit for. The only question left is whether you're willing to use it.